You ever wish you could just, zero in on what makes a business tick financially without getting bogged down in all the complex accounting stuff?
Yeah.
Well, that's exactly what we're doing today. We're taking a deep dive into a really useful metric called earnings before interest and taxes, or EBIT for short. Think of it like a financial x-ray, sort of giving you a clear view of a company's core profitability.
That's a good way to put it. Our goal in this deep dive really is to give you a solid grasp of EBIT. What it tells us about a company's operations, why it's such a valuable tool for understanding financial health, and how you can actually calculate it.
Right.
We've looked at, well, a range of financial guides and articles to bring you this practical knowledge. Doesn't matter if you're running your own business, maybe studying finance, or just curious about what makes companies profitable at their core.
Okay, so drilling down then, in simple terms, what are we really looking at when we talk about EBIT? What's the essence of it?
Well, at its heart, EBIT reveals the profit a company generates from its regular business activities. This is before we even consider how it finances its operations, through debt, or how much it pays in taxes.
So it strips those out.
Exactly. You might also hear it called operating profit or operating income. Now, there can be subtle differences sometimes in how things are classified, but for our purposes today, those terms are essentially interchangeable. They focus on that core earnings power.
Right. Why is this particular profit figure so important, though? I mean, what can EBIT tell us that other numbers might hide?
Well, EBIT is insightful because it allows us to really evaluate the efficiency of a company's operations. It helps us compare the performance of different companies on a more level playing field.
How so?
Because it doesn't matter what their debt levels are or the tax rules in their specific locations. EBIT sort of standardizes that view. It also gives a good indication of whether the fundamental business is strong enough to cover its day-to-day costs and potentially service its debts down the line.
Ah, okay. Like, you mentioned an analogy before, the lemonade stands.
Right. Imagine 2 lemonade stands. EBIT helps you see which stand is, well, fundamentally more profitable at just selling lemonade, regardless of whether one owner took out a loan for their fancy pitcher or maybe operates in a town with a higher sales tax. It isolates the core operation.
That makes it really clear.
Yeah.
Okay, so how do we actually get to this EBIT number? What are the ways to calculate it?
There are basically 2 main approaches. It really depends on the financial information you have in front of you.
Okay.
The first way starts with the company's total revenue. This one's especially handy for getting a snapshot, say, mid-year, or for preliminary evaluations. The formula is pretty straightforward. EBIT equals total revenue minus cost of goods sold minus operating expenses.
All right, let's break down each of those pieces. Total revenue, what exactly does that cover?
Total revenue is, well, simply the total amount of money a company brings in from selling its products or services. It's usually the very first line item you'll see on an income statement, sometimes called sales revenue.
It's to the top line. Got it. And then we subtract cost of goods sold. What does that include? What's COGS?
Right, COGS, or cost of goods sold. It includes all the direct expenses tied directly to producing the goods or services that generated that revenue.
Direct expenses like?
Things like raw materials, the wages of the factory workers, other costs directly involved in the creation process itself. A simple way analysts often calculate it is beginning inventory plus purchases during the period minus the ending inventory. That difference is your COGS.
Okay, so if we're thinking about that car company example you mentioned earlier.
Yeah, exactly. If our car company starts the year with, say, 80 cars, buys 25 more during the period, and ends the period with 30 cars still unsold, the cost associated with the 75 cars they did sell, that's the cost of goods sold.
Okay, direct production costs. Makes sense. And the last part of that first formula was operating expenses. What fits into that bucket?
Operating expenses, sometimes called OPEX, are the costs of running the business that aren't directly related to producing the goods or services.
So mere general costs.
Exactly. Think things like administrative salaries, rent for the office space, marketing and advertising budgets, utilities. These are the everyday expenses that keep the business functioning, but they're separate from the actual creation of the product. You'll find these listed on the income statement, too.
Got it. So revenue minus the direct costs of making what was sold minus the general running costs.
Yeah.
Okay. What's the second way to find EBIT? You mentioned 2 methods.
Right. The second method, this one starts from the other end of the income statement with the company's net income.
The bottom line.
The bottom line, exactly. Net income is the profit left after all expenses, including interest and taxes, have been deducted. This method is often used when you're looking at full annual reports where net income is clearly stated.
Yeah, and the formula.
Simple again. EBIT equals net income plus taxes plus interest.
Okay. So in this case, we're just adding back the things EBIT is supposed to ignore, the interest and the taxes, to get back to that operational profit figure.
You've got it. You find the net income figure, usually right at the bottom of the income statement, and then you just add back the total income tax expense and the total interest expense that were subtracted earlier to arrive at net income.
Okay.
Now, it's worth mentioning, while EBIT is a really useful internal metric and widely used by analysts, it's not always explicitly labeled as EBIT on standard financial statements prepared under, say, GAAP rules.
Oh, so what might we see instead?
You might see a very similar figure called operating earnings or income from operations. It often lines up pretty closely with EBIT.
We sometimes hear about companies having, big one-off gains or losses, like selling a building or a lawsuit. How do those unusual events affect EBIT? Should they?
That's a great question because the goal of EBIT is really to measure the ongoing performance of the core business. Analysts will often adjust for or exclude the impact of unusual or one-time items.
To get a cleaner number.
Exactly. Things like a significant profit from selling off a division or maybe a major cost from a legal settlement. Excluding those helps provide a clearer picture of the regular, recurring profitability.
What about things like interest earned? If a company has investments.
Good point. Non-operating income, like interest earned on investments, might be treated differently depending on the nature of the business itself. For a bank or a lending institution, for instance, interest income is absolutely central to their operations.
Right, that is their business.
So it would definitely be included in their EBIT calculation. But for, say, a manufacturing company, if they earn a bit of interest on some bonds they hold, well, an analyst might choose to exclude that to focus purely on the manufacturing operations.
So judgment is involved.
Yes, and consistency is key. If you're comparing companies, you need to apply these kinds of adjustments, if any, consistently across the board.
Okay, so EBIT gives us this good snapshot of operational profit, but it's not perfect, right? What are some things it doesn't tell us? What are its limitations?
That's a really important point to understand. One key limitation revolves around depreciation.
The D in EBITDA later, maybe.
Exactly. Companies that have invested heavily in physical assets, think factories, big machinery, delivery fleets, they'll have significant depreciation expenses.
Which are counted in operating expenses.
Yes, depreciation is usually part of operating expenses, or sometimes COGS, and therefore it reduces EBIT. This can make a very capital-intensive business appear less profitable on an EBIT basis compared to a similar company with fewer physical assets, even if their underlying operational efficiency is comparable.
So like a software company with mostly programmers versus a heavy manufacturing plant.
Precisely. The software company might show a higher EBIT just because it doesn't have massive factories depreciating, even if the factory is running super efficiently. Remember, depreciation reflects the cost of using those assets over time, but it's a non-cash expense.
Right. No actual cash leaves the building for depreciation each year. Okay, what are their limitations?
Another crucial one is that EBIT doesn't take debt into account at all.
Because it adds back interest.
Right. By ignoring interest expenses, EBIT can sometimes make a highly leveraged company, one with a lot of debt, look more profitable on the surface than it perhaps really is. High debt levels carry real risk, financial risk, and EBIT alone won't highlight that burden.
That seems important.
It is. Also, interest costs aren't static. Interest rates fluctuate, and those changes can significantly impact a company's actual bottom line, its net income, but EBIT, by definition, won't reflect those interest rate changes directly.
Good point.
And finally, maybe more practically, it's worth acknowledging that for someone just starting out in finance, calculating EBIT correctly, making those judgments about adjustments, it can have its challenges.
Yep.
If you ever feel overwhelmed looking at financial statements, seeking advice from a financial professional is always a sensible idea.
Absolutely. Now, you mentioned depreciation, which naturally makes me think of that other common term, EBITDA. How does EBIT differ from EBITDA? What's the distinction?
Right, EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization.
So 2 extra letters, D and A.
Exactly. The main difference is that EBITDA goes a step further than EBIT. It also excludes depreciation and amortization expenses from the earnings calculation.
What's amortization? Quickly.
Amortization is very similar to depreciation, but it applies to intangible assets, things like patents, trademarks, copyrights, goodwill from acquisitions. Depreciation is for tangible physical assets.
Okay, so EBITDA excludes D&A. Why is that seen as useful?
Well, depreciation, as we said, is a non-cash expense. It recognizes the cost of using assets over their lifespan, and it does impact a company's reported net earnings. By removing depreciation and amortization, EBITDA aims to give an even clearer picture of the actual cash a company is generating from its core operations, before considering financing, taxes, and the accounting conventions of D&A.
So it's often seen as a proxy for operational cash flow.
That's the general idea, yes. It can offer a deeper insight into that cash generation. However, it's really crucial to remember that depreciation and amortization aren't just accounting fictions. They represent real economic costs, the wearing out or using up of assets. So ignoring them completely can also be misleading.
So both are useful, but for different things.
Definitely. Both EBIT and EBITDA are valuable tools in financial analysis, but they provide different perspectives and are useful for different types of analysis and comparisons. Neither tells the whole story on its own.
Let's try to make this really concrete with an example. Can we go back to our hypothetical car company XYZ? How would we calculate their EBIT using that first method?
Okay, sure. Let's put some numbers on it. Let's say for the first half of the year, XYZ had total revenue of $45,000 from selling cars.
Okay, 45K top line.
Now, for the cost of goods sold, let's imagine, using that inventory method, we figured out that the direct cost of the cars they actually sold during that period was $15,000.
15K COGS.
And let's assume their operating expenses for that 6-month period, things like showroom rent, salespeople's salaries, advertising totaled $6,000.
6K UpEx.
Right. So, using our first formula, EBIT, total revenue cost of goods, sold operating expenses. We plug in the numbers, $45,000 minus $15,000 minus $6,000.
Okay, 45 minus 15 is 30, minus 6 is $24,000.
Exactly. So XYZ's EBIT for the first half of the year would be $24,000. This gives us a clear look at their operational profitability from selling cars before we worry about any loan interest or income taxes.
That really helps solidify how the formula works with actual numbers. So stepping back again, how is EBIT used in the bigger picture of analyzing a company's financial health, especially when maybe comparing different companies?
Yeah, that's where its power really lies. EBIT becomes particularly valuable when investors or analysts are comparing companies that operate in different tax environments.
Right. You mentioned the level playing field.
Exactly. For instance, if one company benefits from a significant tax break, maybe a government incentive, while another similar company doesn't, their net incomes might look very different just because of that tax policy.
Making one look much better on the bottom line.
Potentially, yes.
Yeah.
But by looking at EBIT, which is before taxes, investors can get a much better comparison of the underlying operational efficiency of the two businesses. It helps strip away that distortion caused by different tax policies or temporary tax situations.
So if two retailers are basically the same, but one's in a lower tax state, EBIT helps you see who's actually better at, well, retailing.
Precisely. It isolates the core business performance from those external tax factors.
Okay. What about when we're looking at companies with different amounts of debt? You mentioned that EBIT ignores interest.
Yes, and that's another key application. EBIT is crucial when analyzing companies in industries that tend to be very capital intensive and often financed heavily with debt. Think about energy companies, utilities, heavy manufacturing, airlines.
Lots of big assets, lots of loans.
Right. These companies will naturally have significant interest expenses due to their debt load. Because EBIT excludes these interest costs, it allows investors to assess how well the core operations themselves are performing and generating revenue without being quite as influenced by the varying levels of debt and the associated interest payments across different companies in the sector.
So you can compare their operational savvy even if one is loaded with debt and another isn't.
It helps do that, yes. It helps answer that fundamental question. Is the basic business model profitable? Is it generating enough earnings from its operations, regardless of how it's financed?
So when you boil it all down, EBIT really seems to be this fundamental measure of how profitable a company's main business activities are, sort of pure and simple.
That's a perfect summary. Precisely. It provides a cleaner, more comparable metric by stripping away the effects of financing decisions, like how much debt to take on and the impact of different tax jurisdictions.
Which makes it useful for
Well, it makes it an essential tool for evaluating a company's capacity to handle its debt obligations, because operating profit is what ultimately pays the interest. It's also used frequently in business valuations, often as a starting point for calculating other metrics, and definitely for benchmarking performance against competitors or industry averages.
So understanding EBIT is pretty foundational stuff.
Absolutely. Understanding EBIT is definitely a key skill for anyone looking to make more informed business and investment decisions. It gives you a clearer lens on operational health.
This has been genuinely illuminating, a really helpful deep dive into EBIT. Now, thinking about those limitations we discussed, considering that EBIT doesn't give us the full picture when it comes to, say, debt burdens or the need
Yeah.
for ongoing capital investment,
hmm
what other financial metrics do you think are essential to look at alongside EBIT, to get a more complete, well-rounded understanding of a company's actual financial well-being?
Mm.
That's maybe a thought for you, our listeners, to chew on after this discussion. We certainly hope this deep dive has given you a strong foundation in understanding EBIT and maybe encourage you to explore the financial statements of companies you follow. See if you can spot that operating income line and see it in practice.
Definitely worth doing.
We'll be back soon with more explorations into the world of finance.